Hey guys, so the time has finally come for me to start my beginner investing portfolio series. If you want to get involved and support this series, you can either create a free account on Trading212 and we'll both get a free share, or you can consider joining the Patreon, which is super cheap at the moment, and you'll see exactly when I buy and sell each of these stocks. With that being said, let's dive straight in. So what's the goal? Each month I'm going to be buying individual stocks or selling them if I feel the time is right. I asked you guys in the community how much you thought I should invest, and the majority, 62%, said £200. So I'll be investing £200 each month. And to kick this off, I'm going to be combining the first 2 months into one video. Now there's a couple of things I need to make clear before this episode starts. First, every company I buy I'm aiming to hold for a minimum of 3 to 5 years unless something drastically changes and I need to sell the company. Second, I am not a financial advisor and I don't agree with promising amazing results. This is something I'm doing mainly for fun and is a very small portion of my total portfolio. And third, a set and forget ETF is much better for a beginner, but as much as I believe your main portfolio should be made up of index funds that you hold for a long period of time, I also feel like the reason I fell in love with stocks is the ability to buy a company I like that I feel is undervalued, hold it and see where it goes. It makes the whole investing journey way more interactive and interesting than passively checking and hoping your index fund has gone up. So for me, this is fun and entertaining, and feel free to follow along if you'd like to and share with me your ideas of companies to buy, because I want this series to be as interactive as possible. Okay, so far I've actually bought 4 positions and I'll talk you through each of these, why I'm holding them, how they're performing, and give you a total update of how the portfolio is doing. The first company I bought is Pets at Home with a ticker symbol PETS, or Pets. Pets at Home is a British retailer selling products including all sorts of pet supplies and pets. Pets at Home is listed on the FTSE 250, founded in 1991, and the company operates 453 stores across the UK as well as their online store. The thing I really like about Pets at Home is they are what I would consider a moat company. A moat company is a company that's built such a strong position in a sector that they're very hard to compete with. With over 400 stores and such an established brand, it's very hard for someone to enter the sector and compete. There's plenty of small mom and pop type stores, but with the margin on the majority of pet products being so tight, the sheer quantity that Pets at Home can order makes it hard for others to compete that want to enter the market. They also offer grooming and vet services from within most of their stores now, which is a huge USP. A good example of this is when you look at the PE ratio to work out its value, it's compared to the likes of WH Smith's and Moonpig, which are nothing like it. Because there's no one to compare them to, they just group them in with a specialty retail industry. After a number of challenging years, the company is now well positioned to deliver consistently strong profit and dividend growth. We can see their revenue and profits have been climbing year on year, and we can see the company has more cash than its total debt, which it's been reducing over the past few years, which is really great to see. It's not any kind of get rich quick position, but it can deliver a healthy gain and a good dividend over the next 3 to 5 years. The dividend dipped slightly through COVID, but it's now back up to a healthy 3.4%, which is paid in July and January, which will be a nice little boost to the portfolio. In Pets at Home, I've invested £100 and I'm currently up, wait for it, a whopping 0.46%, which has made me 46p. Yay! This was doing pretty well, up around 5%, but it's fallen in the week roughly to back where I bought in. But of course, I'm looking at a much longer timeline, and also remember, past performance of the chart isn't massively important. But of course, it would be nice if it returned to the September 2021 levels of 500p per share. Fingers crossed. Next up is a company called Greencoat UK Wind with a ticker symbol UKW. Greencoat UK Wind PLC is a renewable infrastructure fund. It's invested in the United Kingdom wind farms. The company's objective is to provide investors with an annual dividend that increases in line with the retail price index, or RPI, while preserving the capital value of its investment portfolio in the long term. Essentially, they aim to pay out a good solid income. Greencoat UK Wind is now trading at 3.7% discount to its net asset value. It's been trading at a premium for most of the time over the past decade. The company is known for paying out strong, stable dividends to investors. The current dividend yield is a whopping 5.1%, which is higher than the average yield for UK equities, i.e. other UK companies. These have been stable and growing over the past 10 years, which is a really good sign. As a renewable energy infrastructure investment company, Greenco is positioned to benefit from the growing demand in clean energy. The UK government has set a target of reaching net zero carbon emissions by 2050 and is cutting emissions by 68% by 2030, which should really benefit the company. It has a strong track record of delivering attractive returns to investors, and since its initial public offering in 2013, the company has generated a total return for investors of more than 100%, outperforming both the FTSE 250 index and the UK equity market as a whole. It's recently acquired Dalquhandy wind farm, sorry if I slaughtered that, and it will benefit from a 10-year fixed price increase power purchase agreement with BT for 80% of its output. Directors and insiders were both buying shares of the company last month, which is also a good sign. I feel like wind is such a great renewable energy source for the future, and this should pick up some nice income to the portfolio, and I'll just continue to add into this position. Again, I bought £100 worth of this stock, and it's currently actually down 4.4%, which makes it a good entry point, and it's had a pretty rough month. I want to show you guys when things are down, because the idea of this series is just to be as transparent as possible and hopefully show you what it takes to build a real portfolio. Before I dive into the next stock, I want to say a huge thank you to NordPass for sponsoring today's video. NordPass has been a lifesaver for me in my business. As most of you know, my day-to-day business is a web design company where I have to work with hundreds of clients' websites. Trying to dig through and remember all of the details for their MailChimp, LinkedIn, Google, domain names, and other various accounts can be such a nightmare. I also have to have secure passwords for all of the accounts that I use. When I first started, I used to keep them all on a notepad, bad, I know, and even a spreadsheet. Since I discovered NordPass, it's been so much easier. I can even give access to my team without needing to share the password with them. It's made by the legendary makers of NordVPN, and I really needed a name to trust. It's definitely worth checking them out. Even if you don't have a business, they have an option for individual use. Check them out and see NordPass in action, and get a 3-month free trial here using the link below with code CHRISBUSINESS. Okay, so stock number 3 is AG Bar, ticker symbol BAG. AG Bar are a huge drinks retailer who are based in Scotland, most notably known for owning Iron Brew. They're a part family-owned soft drinks business that has an attractive brands portfolio. It grew like-for-like sales by 15.9% in its last fiscal year, and it's seeing impressive momentum from its Funkin brand, the UK's leading ready-to-drink cocktail brand, which I love, which has been growing revenues by 16%. The company says that 9.6 million UK customers drink cocktails at home, a 1.6 million increase since the pre-pandemic period, which has helped the category increase by 13% to 686 million since 2019. This looks like a really good growth avenue for the company. The recent acquisition of Boost Energy has performed exceptionally well. It's currently trading at around 16x forecast earnings and a discount to the 3-year average of closer to 20x. Drinks tend to be a super defensive sector. When things get tough, people love their brands, and even more so, alcohol. Its PE ratio is much lower than its competitors, and it's currently 34% undervalued. I invested £150 into this company, and it's currently 2.61% down. I'll continue to buy into this one as it's such a great entry point, and we can see the stock price has been almost double in the past. Of course, that's not a guarantee it's going back there, but all the signs are pointing in the right direction. And last but not least, my last buy was the Vanguard FTSE All World Fund, the accumulation version. And that one is a ticker symbol VWRP. Now I know you're probably thinking this is an index fund and not a stock. The reason I bought this is so I can benchmark the portfolio to see how it's doing against the stock market. And hopefully over time the portfolio will outperform it. There's no guarantee that it will, but it's fun to compare it against it all the same. My main portfolio has certainly outperformed the market at certain times. It'll be really interesting to see if buying undervalued solid companies can perform better than just buying an ETF. That one is currently up nearly 2%. I won't be adding any more to that position, just using it as a benchmark to track performance. So here's how my full portfolio is looking so far. You can see how the portfolio has been climbing, but I do have to admit it's sort of been skewed by the free shares that I've been given. You can see I've had some nice ones in Amazon and Google here, and a few that I need to get rid of. I'm undecided if I'll keep some of those I think are good value and maybe top them up, or just sell them off. Let me know what you guys think about that. I've actually had some seriously good free shares, and they seem way more valuable than the ones I got from free trade, which were about £3 each. The best one I've had so far was worth around £85. It's well worth grabbing one as it only takes a few minutes, and I'll leave a link for you down below. I've also got a trading pie here, which is a really neat feature of Trading 212, where you guys can see my allocation of each share into the portfolio. I can actually share this with you guys, so I'll pop a link to it in the description too. So yeah, I'm quite excited to see where this can go. I'm about to invest my next £200 right after I record this video. I haven't quite decided how far to take this portfolio yet, whether the goal should be £1,000 or maybe £10,000. I'm aware that at £200 per episode, £10,000 may take around 50 episodes. Maybe I'll combine a few months into one. Let me know what you guys think about that too. So thanks for watching. Do subscribe and follow along to see how far we can take this. And if you haven't yet seen my main series where I'm building up to 100k, check that out as I'll have another episode coming very shortly.